Which is better? Is renting or owning a home a smarter choice? It is said that you should always try to buy a house, as you are throwing away your money when you're paying rent. Or another one you might have heard of is that you are paying somebody else's mortgage. But in this day and age, is that true? Aloha everyone, it's Rick here with goodincomestreams.com and the author of Invest Like the Rich. And on this video, we'll be talking about which is truly better. Is renting or owning a home the better choice? Now, to break this down, we must really look at everything. Unless you have a lot of money in the bank or you're a millionaire, which you should be owning your own home, you might have to take a loan out. And usually that loan is about 30 years. I mean, there are other loans out there that's like 15 years or 10 years or whatever amount you want, but the average is usually a 30-year fixed mortgage. And so because that's the norm and that's what everybody does and that's what I do, I mean, every time I purchase a home, I mean, except for when I'm doing tax liens and tax deeds, I usually purchase a home with a 30-year fixed mortgage. And now I'm going to show you guys a breakdown of how much money you'll be making. Later on, I'll show you all this stuff towards the end of the video, and I will show you the comparison of renting versus buying. Now, if you're enjoying this video, please let me know in the comments below. Also, smash that like button and the subscribe button and the notification bell so that YouTube will notify you the next time I upload another video. So because you are purchasing it for 30 years, that means you are locked in. And if you decide you don't want to live there no more, you're not going to be able to move. So that's the downside. You won't be able to move fairly easily. Versus if you were renting and you weren't happy with it as soon as your lease is over, depending on how long the lease is, whether it's month to month, 6 months, 1 year, 2-year lease. Once that lease is over, you can just up and go. When you own a home, you cannot just easily move up because you have to look at cost, right? I mean, if you just purchased a home, then you trying to sell it might be a little bit more complicated than that because you got to look at closing costs. So you got to recoup that closing cost when you purchase the home. And then when you sell the home, there's even more closing costs. Plus you got to pay your agent, your agent, the buyer's agent. There's a lot of money involved when you sell a home. So unless you've owned that home for a while, selling it immediately within the first few years might not be a great idea. Now, unless that property has grown in equity significantly, then you are going to be stuck. And plus, on top of that, when you do try to sell a home, you usually take anywhere from 30 days, 40 to 45 days is like the quickest turnaround time. And I've seen properties sit on the market for 6 months, a year, 2 years, and they just constantly dropping the price and now they're losing money, which I do not recommend, by the way. So if you're somebody that doesn't want to be tied down or doesn't want to stay in one place, then maybe renting is the better option for you. But you got to watch the rest of this video to see exactly why I believe that owning a home is better than renting for a lot of other reasons. Now, if you're somebody that just likes to move, then maybe renting is better for you. I mean, I know a lot of people that don't want to own their own home because they like to travel a lot, which is fine, and they like to move from place to place. But have you ever really thought about it? Have you moved recently? You know that it costs a lot of money to move. I mean, you can do it yourself and, pack up and go, but that takes a lot of time. So if you're not spending money to pay for movers, you'll spend money in other ways. So one is you probably will have to rent out a U-Haul or some kind of vehicle to take all your belongings. Now you could probably shuttle it with your own vehicle. That might take you 5, 10, 20, 30, 50 trips, who knows, right? Because you might have a smaller vehicle. If you have a larger vehicle, maybe it might be easier. And then two, you also have to look at how much is your time really worth when you're moving? And how much time do you spend? Now, if you're going to tell me that it will take you 2 hours to move, then you are probably the fastest mover in the world, or you're the best renter out there because I've never heard of anybody that's able to move that quickly. Getting people to help you. Now, if you're a large family, then maybe it's a different story because you have a lot of help in picking up your items, right? Like so your cabinets, your beds, even your appliances or whatever else you have that you're going to take with you when you move to your new place. And then on top of that, a lot of times you might even have to take off from work just so that you can move. Now, all these things start to add up. So you're not getting paid. You might have to rent a vehicle, or if you're using your own vehicle and you're going back and forth 20 times, you got to look at the amount of gas you spend on going back and forth. Plus, all your free time that you just spent moving, if you did that during your free time after work, it still adds up. And then on top of that, you might even have to pay for rent for two places at the same time. Because a lot of places will not allow you to move in unless you are paying rent. And then with your old place, if you're moving out of that old place, you need to move out, or you need to have that place cleaned up by the time you say that you're going to move out. So because you have to overlap so that you can move your belongings from one place to another, then you might have to pay for a few extra days or weeks. Who knows, depending on how fast you can move. So all these things start to add up, which is why sometimes I prefer to just own a home and I just stay in one place. Now, yes, that might not be that exciting, but then again, the amount of money that you save and the amount of time and headache that you save from not moving, you could probably use that to spend time with your family or take a vacation or do something else rather than stressing on moving, right? Oh, by the way, before I forget, you might be thinking as well that, well, what if I move, I just have very little things, very few items, or maybe even I just leave all my belongings in suitcases, all my clothes in suitcases, and I just dig through that. As smart as that might sound, isn't that a little crazy how just so that you can easily move, that you'll just keep all your belongings in suitcases or boxes, so that way you can just up and go anytime you want? I go traveling with my family every time, and you know what I hate the most is having to dig for that one item in that suitcase and spending half an hour to an hour trying to dig for it, and come to find out it wasn't even in the suitcase because it was placed someplace else. I'm not sure about that idea, but if you want to live like that, go right ahead. Now, the second one will be opposite from the first one. So because the first one you wanted to be easily mobile, where you're versus owning a home, you'll be stuck in one place, the opposite can be said as well, is that what if you enjoy that place? What if you like living in that home, but you're renting? Guess what? You'll never know how long you'll be able to stay there. Now, granted, of course, if you sign a long-term lease with the landlord, then you'll be there until the end of that lease. But what if that landlord decides that at the end of the lease, he's not going to renew it because he changed his mind? He wants to sell the home, or he wants to rent it out to somebody else for much more money. Or maybe he decided that his family is going to move in with him, or has decided that he does not want to have any more tenants. He does not want to deal with tenants anymore. Then you'll be forced out of that place. Now, of course, I mean, that's not always what's going to happen, but just that uncertainty always makes me feel uncomfortable when I was renting back then. Renting is not the best when it comes to that, because there's no stability. There's no guarantee that you'll be in the same place 5 years down the road, right? Versus owning a home, as long as you pay your mortgage, you pay your taxes, and you pay all that stuff, you know that you'll be in that same house for the next 10, 20, 30 years, as long as you want. Now, the third thing is that you can do whatever you want. If you decide that you want to paint the inside, you can paint it pink, purple, or you can paint all the walls black for all you want. I mean, granted, of course, if you're in an HOA place, then yes, you might have to follow their rules, and you might have to paint the outside of your home, or the color of your roof might have to be a certain color, and you might have to follow all these other regulations. But for the most part, you're allowed to do a lot of stuff. Versus renting, did you know that a landlord can actually charge you if you put holes on the wall? So like, let's just say you want to put that picture on the wall. Just putting that small hole there for your nail to hang your picture, you can actually get penalized for that. And you have to pay for a handyman to come in and patch that hole, even though it will just take a tiny little spackle and you put it on and then maybe some touch-up paint. But because you are a tenant and the landlord wants it fixed, especially if they find out that you put a hole in that wall, and be expecting to pay something. Well, in the fourth one, we're going to talk about the amount of money that you spend. You actually have to buy a home, versus renting, you just have to pay somebody the rent, right? So when you purchase a home, it's usually a significant amount. It's rather large amount, versus when you just pay the rent, which is usually you just have to come up with the deposit, which is usually about a month's rent. Let's just say, for example, you're renting a 3-bedroom home for $1,800. So you just have to come up with $1,800 as your deposit and the first month's rent, which is another $1,800. So a total of about $3,600, more or less, right? I mean, I know some other places nowadays, they actually ask for the first month and the last month's rent. So you end up paying about 3 times the amount. So instead of 3,600, you just add another 1,800 to that, and that's about 5,400. As large as that sounds to some people, purchasing a home is much larger than that. Usually, we're talking about 6 figures. Now, if you have any questions, don't forget to leave a comment down below, and I'll be more than happy to answer those questions. Owning a home, you will have to pay for possibly a down payment. You might have to pay anywhere from 5% to as high as maybe 20% or more, depending on the loan. And 2 is you have to pay for closing costs. Now that can add up as well because it's usually around 2 to 5% of the purchase price. Now it's adding up. And then you might have to pay for other things like even moving costs and whatever else, right? Although there is ways around it and you could actually have the seller absorb some of this cost, but you might still have to pay for the down payment. Granted that there are first-time home buyer programs out there that allow you to get away with no down or very little down, but I mean, you might want to shop around because you're going to have to make sure that you get the best mortgage out there with the best rates. Remember now, if you have a higher interest rate, you're going to end up paying more towards the end because you have to pay for more interest versus if you was to make like a small down payment versus no down payment, you might save a lot more. And on top of that, you might even have to pay for private mortgage insurance because you're putting down less than 20% of the purchase price. Now, when you add all that up, that's a significant amount of money, especially if you're here in Hawaii where the average median price is around $850,000. That can add up real quick. Now let's talk about renting. So remember how I mentioned that you might only pay deposit plus the first month's rent and maybe the last month's rent on some places. So you might end up having to pay for about 3 months worth of rent up front. But then after that, all you got to do is just pay your monthly rent. Now, if your rent is $1,800, then that's all you have to worry about. Granted, you might have to pay for insurance if you want to get renter's insurance. Now remember, some landlords do require you to have renter's insurance, so that way your belongings are covered. It's only a few $100s a year. I do believe it's anywhere from like $100 to $200. I mean, depending on where you are and depending on what you want covered, it might cost more or less. Versus a homeowner's insurance, it can cost anywhere from like a few $100s, like maybe $400 or $500 to $1,000, $1,500. Then you also have to worry about taxes. So when you own your own home, you got to pay for property taxes. Now, if you're renting, depends on your landlord. They might make you pay for general excise tax. Now, this depends, of course, on the state that you're in. But here in Hawaii, yes, we do have GE tax, and sometimes the landlord does pass it on to the tenant. And those taxes are very nominal compared to paying for property taxes. Now, remember now, property taxes do pay for a lot of things like schools. So schools, they get their funds usually from property taxes. Now, the police also gets their funding or their money from property taxes. And then you also have your emergency personnel, like maybe even your firefighters, amongst other things. They're usually covered by property taxes. Now, the fifth one I want to talk about is that you always know what you're going to pay. Now, granted, of course, if you own your own home, that you might have all these expenses compared to just rent where you just pay one amount and then maybe insurance and taxes. With a mortgage, you will pay the same exact amount every month for 30 years. So imagine you take out a loan for 30 years and let's say you purchase a home. Let's say we'll pick one from California, $300,000 home. I know some places might be more expensive, other places might be cheaper, but let's just say it's a $300,000 home and you finance the whole thing. You know that your mortgage, your principal and interest mortgage for 30 years on that loan is only going to be a little over $1,300. To be exact, it will be $1,347.13. Now, of course, that's only for your principal and interest. That doesn't count for your taxes, your insurance, and maybe even your private mortgage insurance if you took out a loan and you did not put down 20%. Now, of course, that depends on the bank. Some will charge, some won't. So, like I said, always shop around and find the best deal that you can get. Even though the principal and interest is significantly lower, I mean, you're only paying a little over 1,300. Like, let's just say, let's round it up to 1,350 versus a rent that you rent a 3-bedroom home, a comparable 3-bedroom home, about $1,800. So you're paying $1,800 for rent versus $1,350 for principal and interest on a 30-year loan for a $300,000 mortgage. Now, if you calculate your taxes, your insurance, and maybe even your private mortgage insurance, you might be paying around $1,900. Now, that sounds like a lot more, but you know that you're going to be paying the same exact amount every single year or every single month, year after year. Versus renting, guess what? The landlord can decide to increase that rent. After a few years, you might be paying more than $1,900 a month. You could be going to $2,000. So is renting truly saving you money? Plus, you got to compute now that you are not building up anything when you are renting versus owning a home. Even if you save, let's just say you're saving $200 every single month. Let's say you manage to get to do that for 3 years. At $200 a month, that's about $3,600. Now, granted, of course, if you own a home, your equity in your property at the end of 3 years is around $17,000. Now, the sixth one continues from the fifth, and this is that you are getting a forced savings. Now, you might be paying mortgage every single month, and it's costing you a lot of money, but at least every month you put down or you pay something, you are saving money, right? Versus when you're paying rent, like I was mentioning earlier, rent, you're just saving money every single month. However, at the end of the year, you have nothing to show. So when I mentioned earlier, 3 years paying rent, yeah, you saved about $3,600 if you manage to save about $200 every month. Versus paying a mortgage, at the end of 3 years, you technically have about $17,000 in equity. Now, I don't know about you, but $17,000 is a lot more than $3,600. Top of that now, properties tend to increase in value. So at the end of 3 years, even though you may have set aside $17,000 because that's how much you paid in principal, your property would probably be a lot more than $300,000. So your equity or the amount of money that you saved up might be a lot more than $17,000. Now, depending, of course, on what area you live in and all that stuff, you got to look at that. Properties tend to appreciate approximately about 3.5%. But then again, that just depends, depending on inflation and depending on other circumstances. Now, if you have any questions, don't forget to leave a comment down below and I'll be more than happy to answer those questions. Now, the seventh one is that you can actually borrow money against the property versus when you rent, you cannot borrow against that property because you don't own it. The landlord won't allow you to borrow money against his property. They won't allow you to borrow money and use that property as collateral. So when you own the property and you've built up enough equity, you can actually go to the bank and say, you know what, I need some cash, I need to pay for something, or I need to buy. I mean, you don't really have to explain to them. Sometimes they do, sometimes they ask, sometimes they don't, but you have that option. You can do like maybe a HELOC, for example, a home equity line of credit. When you open a HELOC, it's like a credit card. You have the money, you borrowed a certain amount, and yeah, you might have some closing costs to do all this stuff. But what happens is, let's just say you want to, let's say your property value has grown and they will allow you to borrow $100,000. I mean, they're not going to hand you $100,000. Instead, what they'll do is they'll give you a checkbook. And that checkbook, you can write up to $100,000 at any given time. Once you cash that check, you will have to start making monthly payments. But until you actually cash that check or you write that check and pay for something, you don't have to pay for anything. So you just open yourself a line of credit, like a credit card. You have that piece of card that you can use to purchase items at the store just in case if you didn't have the cash. Now, of course, I do not recommend you buying anything that you cannot afford or you don't have the money for, because then when you end up in debt, then of course you're gonna struggle, and then you might even lose your property because you cannot make your mortgage payments. This one, the HELOC, at least it's there. It's an option for you. You can borrow if you need it. Or maybe you want to invest, you want to buy more properties. That's a great way to actually start investing. That's actually how me and my wife got started. We had our first property value increased. We took out a HELOC. We had that check, and we could write up to, I do believe it was like around $110,000, $120,000 back then. And what did we do with it? We bought an apartment. And then from there, we bought our third home. And that's how we got started. Now it's been a lot harder to purchase homes here in Hawaii because the property values have increased significantly. So I've been investing in out of state, but that's for another video. Now, the last one that I want to mention is that you actually get tax benefits. So when you own a home, you can actually write off those interests that you've been paying on that mortgage. Now, of course, that depends. So if you are not making a significant amount and every time you file your taxes, you pretty much get most of your money back because of all these deductions, then this might not work for you. But if you're somebody that's earning a significant amount and you pay a lot of taxes, then guess what? You can offset your taxes with the interest. So remember, I'm not an accountant or a financial advisor, so please consult with them before you proceed with this. But this is something that we do. We get this form 1098, which is called a mortgage interest statement. And the banks send this to us every year. And what we do is we put that together with all our other income, and we send that to our accountant to file our taxes. And that's why we were able to write off some of those interests. And it helps us out because it offsets some of our income. And of course, yeah, you're not going to get all your money back. But at the same time, is if you really try to offset, if you really compute how much you pay in interest every year, and then you offset that with your taxes, so you pay less in taxes. And by the way, who doesn't want to pay less taxes, right? I mean,
if you like paying taxes, you know what? Let me know so that way I can file your taxes for you. And then from there, what I'll do is whatever returns you get, I'll keep it for myself. Nah, I'm just joking. I mean, I don't do that anyway. I pay somebody to do my taxes, so you wouldn't even want to trust me. I'm filing your taxes. So
now, if you were renting, there's no way you can actually claim that or offset that with your taxes. Now, of course, again, like I said, talk to your accountant or your financial advisor about that. I mean, maybe there's a way. I don't know about it, but I know that you can write off your mortgage interest. This is why I lean more towards owning versus renting. Now, I've mentioned 8 things on why renting or owning a home is better, right? I mean, there are some points that renting might be good, especially in the beginning. But for the most part, almost every single time, owning a home has always managed to show why it is better. So let's just say you've lived in this home for quite a while. Let's say you stayed in that same exact home for 30 years. Now, if you were renting, I'm pretty sure if you started at $1,800 when you first started renting, there's no way at the end of 30 years that you will still pay $1,800. That you might pay a whole lot more than a homeowner or a person that owns his own home. Yes, he's paying mortgage and sometimes it's a lot more than renting. But at the end of 30 years, or by the time you hit a certain number, I'm pretty sure paying for a mortgage ends up becoming a lot cheaper than renting. Now, granted, of course, you might have to pay for maintenance and all that good stuff, which is something that the renter does not have to worry about because that's the landlord's responsibility. Like, let's just say the roof started leaking. Now, that's not no $2,000 job. If you have to replace the whole roof, you might be looking at $10,000, $15,000, $20,000 in expenses. That might discourage some people from owning their own home. However, that's something that I do not fear. If you really look at it, and this is not something that I've mentioned, as a homeowner, you should set aside a certain amount of money every single month or every single year to make sure that you have enough funds to pay for anything that goes wrong. So it's almost like an emergency fund. So remember I mentioned in my other video that you should have an emergency fund. This is something similar to that, right? I mean, on top of your emergency fund, you should have something for repairs and maintenance. When you set aside, they say it should be anywhere from about 1 to 2% of the property value. If this was a $300,000 home, you should be setting aside at least $3,000, and you can just break that down to monthly and you can set that aside. I'm pretty sure you're not going to use that money every single time because how often are things going to break? I mean, things will break. Don't get me wrong. Something will leak. The kitchen sink will leak or break. The toilet might stop working. And then you're going to have to call somebody. But even then, you're not always going to dip into all of that funds. So if you set that aside after several years, that amount can actually grow significantly. And you know what? You might not even have to put in any more money if you have a large amount. Let's just say you've set aside $50,000 after several years. I know that sounds like a lot, but if you were just chipping away and maybe you were setting aside $3,000 every single year, after 10 years, you're already at $30,000. I mean, granted, you're going to dip into that here and there, but even though you have those extra costs and you might have to pay for all of this, you still have to look at the end of 30 years, when you're renting, you have nothing to show. You pay a lot more in rent, but you own nothing other than the belongings that you have that you brought into that home. Versus owning, at the end of 30 years, granted you had to spend money to fix it up to maintain it, you still have equity. After 30 years, that $300,000 home is not going to be $300,000. I'm pretty sure it's going to be a whole lot more than that. That's the best part. If you paid it off after 30 years, guess what? When you sell it, you're going to get most of that money. Now, remember that when you do sell, as of this recording now, as long as you resided in that home 2 out of those last 5 years prior to your sale, then you will not have to pay taxes on the $250,000 for a single person and $500,000 for a married couple. So, I mean, you must consult with your accountant, your financial advisor about all this, just to make sure that you are doing the right things, you are following legal procedures, but you're pretty much saving a lot of money when you don't have to pay taxes. And who likes to pay taxes? Like I mentioned earlier, if you purchase a home in California for $300,000, your mortgage, your principal and interest mortgage payment will be about $1,347 and some change. Well, at the end of the first year, you're gonna pay a total of $16,165. If you only had a $1,800 more rent, then your numbers will be higher. However, there's other things that is being added, right? Renting would be $21,600. Now, with the insurance, homeowners insurance is a lot more than renting, because you can see that this is $1,500. Now, this number, of course, is not exact. This is just an estimate versus the renter's insurance, which is only about $200. And this is what I got from my research. So $1,500 for homeowners insurance versus $200 for renter's insurance. So it's much larger. And then you have your property taxes. This is the exact amount, this property that I looked at in California that sold for $300,000. And then you have your repairs and maintenance of $3,000, which your home ownership total for 1 year came out to $23,212 versus renting, which only came out to $21,800. Less than $2,000 that you paid, and you're owning your own home. Now, granted, of course, there's no PMI or private mortgage insurance on this calculation, but this is just an estimate, right? And so you can just add a few more $1,000s if you had private mortgage insurance. But if you look on the bottom, it says there the equity gained $5,757 on year 1 versus renting, you got nothing, zero. And then if we look at the following year, now your rent has gone up. And I know maybe you can get away with the same exact rent, but I just based this off of rent increasing by a certain percentage, and it was supposed to be more than $100, but I just rounded it off to 100 to make it an easy number to calculate, which came out to a total of $22,800. Now the principal and interest is still the same exact amount as year 1. The insurance, I just made it the same. The property taxes, I just increased it. Repairs and maintenance, I increased it as well, just to make sure that we keep up with the property value. Total expense was $23,765 versus renting, which is only $23,000. If you look at the two, you're only saving about $765. Now, granted, of course, there is no private mortgage insurance on this. At the same time, even if there is private mortgage insurance, it's such a small amount. But when we go down to how much equity is gained, you're gaining up $11,720 versus renting, which you get zero. Now let's fast forward to 5 years. Principal and interest, still the same amount, but the rent 5 years down the road, there's no way you're going to be paying the same exact amount. I just went with $2,200. So your total rent will be about $26,400 with your $200 insurance. I just kept it the same versus the homeowners, which is $69. I just increased it a little. I'm not sure it will be that much. It might be much cheaper, it might be more expensive, but these are just estimates. So if we look at everything, property taxes went up, repairs and maintenance is much larger. We put it at $5,000. I mean, I know that's a lot. Even if you spend $5,000, your total expenses is only $25,665. If we look at it, total expenses after 5 years, you spent $121,922 without private mortgage insurance versus renting, which is $121,000. Now, yes, you might be paying more, but look at how much equity you gain. You already gained almost $31,000. With appreciation, it's going to be a lot more than that, significantly more. Now, let's fast forward to year 10. So now you live in the same place for 10 years. And let's say because rents kept going up, you moved around a few times and you managed to keep your rent significantly lower at another place. So you move, like, let's just say you move twice or even 3 times to just keep your rent as low as possible. So now you in this place, you manage to get rent for $2,200. I know it sounds a lot more than $1,800 again, even though you move a few times, but you're talking about 10 years later. The chances of you paying the same exact amount of rent from year 1 to year 10 is highly unlikely. So you're paying $26,400, so pretty much the same as in year 5. Even though you're paying the same amount in rent, the mortgage is still the same. The insurance may have gone up a little for both, or maybe homeowners gone up a lot more. But even if everything goes up, your property taxes, your repairs and maintenance, your annual expense is at $29,165. Yes, you saved $2,400. If you look at the overall after the end of 10 years, the total expenses is not that much more difference. $260,000 for home ownership versus $251,000 for renting. And then when we look at the equity gain, we're at $67,719 versus renting is $0. Even though you save, let's just say $9,000 after 10 years renting, you're not building up anything for your wealth, for your retirement, for your future, which is something that you need to be looking at. Now let's look at what it looks like at the end of 30 years. At the end of 30 years, you would have paid a total of $485,000 principal and interest, and you would have paid a total of $75,000 in homeowners insurance. And the property taxes at the end of 30 years, let's just say you paid $105,000. I know that sounds like, these numbers sound a lot. At the end of 30 years, you would have paid a total of $890,000. That's including repairs and maintenance. Now, I don't know if you're going to spend $225,000 on a property, but these are just estimates. And I mean, this $225,000 is ridiculously high. But this is just whatever we saved up, whatever we kept setting aside. And we just kept adding on and adding on. And after 30 years, this is supposedly what we spent, or what we set aside. Total expenses, it shows at $890,000. Oh, that's a lot. But this is how much you spent 30 years. Your equity gain was only $300,000 because that's how much the property was when you bought it. But if you maintained it properly, you fixed it up, you did everything, made it look nice, I'm pretty sure at the end of 30 years, it's not going to be $300,000. It's going to be significantly more. It might be double or triple, who knows? Because property values do increase every single year. If we look at renting, we paid a total of $720,000 in rents. And this is based off what we were calculating, starting at $1,800 and going to $2,200 and up and down, whatever, right? Now, I kind of just rounded this off. It's actually supposed to be a little bit more, but I just kind of rounded it off to $720,000 in rents. And I didn't even add renter's insurance. So let's just say you didn't do renter's insurance. Then you would have just spent $720,000. So if you compare the two, you actually save $170,000. So that's a huge difference. You rented, you saved $170,000. That's a big number, right? So renting sounds a whole lot better. It's actually winning when it comes to savings. But we don't own anything versus owning a home. At the end of 30 years, you have a property. And on top of that, I'm pretty sure at the end of 30 years, you're not going to be in the same place. There's a high chance that you would have moved onto another property. Now the question is, would you keep your first property and then just buy another one? That way you can stack it and you can have several properties, and maybe, who knows, at the end of 30 years, you might have 4, 5, 6 properties, and you're just collecting rents from all these properties. Now you just have passive income. Even if you was to set aside money for maintenance and repairs every single month, you're still getting passive income. And that's something that I mentioned in one of my other videos, which I'll leave a link up here about passive income through real estate. Now, if you enjoyed these kinds of videos, you can also check out one of my other videos up here and down here. Please don't forget to smash that like button and the subscribe button as well. And don't forget to hit the notification bell so that YouTube will notify you the next time I upload another video. Now, I'd like to say mahalo for watching this video, and remember to always strive for financial independence. And until the next time, aloha.